Hey everybody, it's hwsteele. Today is March 24th, 2020, and in this video I'm going to talk to you about the 1929 annual stock forecast, yet again, of W.D. Gann's. But we're going to talk a bit about price and how price behaved relative to what Gann was expecting it to behave. And then we'll talk a little bit about why the outcome was like it was, and then follow up at the end of the video with something from the 1929 forecast that I wanted to point out to you guys. So if we look at this is curve 1, which we expect the Dow Jones Industrial Average to follow. And we already went through and talked about the dates, and in other videos, basically the conclusion can only be come to that this particular forecast is not very special in reality. Moving from there, if we look at the price aspect of it, because Gann gave us both the time element, the polarity element, and in other words, the polarity of the particular swing he was looking for, and the amplitude of the swings, he also gave that of what he was expecting. Now, he didn't specifically give an actual amount of points that he was expecting necessarily, but the relative move is actually ingrained in this forecast, meaning, for instance, we move from 0 down to -8 right here, or an 8-point move relative, and then up here we move to +2. So while we had an 8-point move down, we had a 10-point move up. So that means that the move up from January 5 to 7 to January 12th, he was expecting 2 points more than this 8 points, which would be 25% more of a move mathematically. And then we're from +2 to -4, so that's a 6-point move. So this move he would expect to be like 75% of this move, so forth and so on. So that's actually how you need to go through and calculate this. How many points was he expecting the move, and how many points did this swing actually move relative to the amount of points expected from other swings, so forth and so on. So if we look at the chart here, here's 1929 again. Here's the high here, and he expected, here we go, the high to be on the 2nd. If we look at, I'll use that in a little bit. If we look at the price here, got too many windows open here. There we go. Let's see, January 2nd, the high price was 308.70, so we'll say 309. And then on 5 to 7, the 7th here, the low price was 293. But then this move up here, he expected about 25% more, so that would be like 20 points. He would expect to move up from 5 to 7, January 5 to 7th, up to January 12th, and it would be approximately a 20-point move. And if we look at the market here, here's basically where it moved up to. There was nowhere near a 20-point move, and so that price forecast was indeed a failure. Then we have a move down of about 75% of the original, and we see that this move from here to here was about 75%, so that one's about good. So I'm not going to bore you by going through the whole thing. You can go through and compare relative movements yourself, and you'll see that they weren't very good, especially when we get to the October part right here, where he was obviously not expecting a crash in October, and quite clearly a crash happened here in the October time frame, the end of October into the beginning of November there. But he was expecting a strong move down in September, and we did get that strong move down, and it was a strong move. It was the strongest move down relative to what had happened previously, so at least that's there. But that whole crash, he missed the crash is what it boils down to. He just missed the crash. So that has to be taken into account for the accuracy of this forecast, because it's just not there. Price-wise, the accuracy is not very good, to be honest with you. So let's talk about why it would not be very good. And now I'll bring up the Gannzilla Pro here, which is free software you can download, get the different circle charts, square 9, hexagon chart, so forth and so on. So let's say that this particular swing of the market price was conjunct the moon. Right here, January 2nd, when this swing happens, we expect price to be conjunct the moon. Let me go ahead and just close this chart right there. We don't need that. So we expect price to be conjunct the moon, and we'll say that at that particular point in time, it was 314 points. I think it was like 309. So we'll just select that instead. So it's conjunct the moon, it's 309 points, that's accurate. And then however long your cycle is that you're using, we won't get into that aspect of the discussion, you expect when that particular swing comes back into play that the price is going to be conjunct the moon on this particular chart. Now, I'm not saying he used the circle of 24 on the Dow Jones, I'm just giving this as an example. So when that time frame comes into play, the moon might be, we'll say, over here. So any one of these numbers right here would be conjunct the moon at that point in time when the swing works its way back around through your cycle. So you can't necessarily know the exact price using just the circle chart. You can kind of narrow it down basically if you incorporate other pricing methods, but out into the future, making a forecast like this out into the future, you can't necessarily get extremely accurate using just a single method like this. So as a result, you could be off significantly from what is happening. So you could be, if let's just say for argument's sake, you're at 195, and that's what you choose to be your forecast for price. But then you have the next swing is going to be related to something else somewhere, and you're expecting it to be an up move, and it works out to be right here on the chart, we'll just say. And so an up move would be over here, so we would expect it to be 200, possibly 224, but it wouldn't be 176 if you were expecting the 195, right? Well, if this price comes in and it's just about accurate, and you expect and you decide, okay, I'm going to give it a 1, 2, 3, 4, 5 point swing is what I'm expecting, but then price just moves like crazy and moves up to the 224 level, your curve on your forecast is going to be wrong because you were expecting that 5 point move as opposed to a 29 point move, which is what you actually got. So because of the mechanics of something along these lines, producing a curve like this that's accurate for price is difficult unless you just really dial in, and you're still going to have a lot of issues with it. Even if you get really good with the price, you're still going to have issues with it. Okay, so that's just an example of why it's so hard to calculate price, and that's because price can do three things. It can move up, it can move down, it can move sideways, where time only does one thing. So when you're working through your cycle, you're just going to move forward through the cycle because that's all time does. But when you're working with price, you might be dealing with a higher price or a lower price than you're expecting, because price can do anything in relative. It can move up or it can move down. It can't do anything. But hopefully you understand what I'm saying here. So the last thing before I end this video, I wanted to close out. I wanted to show you that, let me close this here. Yup. Save that. All right. This is the 1909 ticker article here. And right here on page 54, we have probably the most popular paragraph out of the entire article. And that's the one about the 1909 September wheat trade. And it goes through like this. One of the most astonishing calculations made by Mr. Gann was during last summer, 1909, when he predicted that September wheat would sell at $1.20. This meant that it must touch that figure before the end of the month of September at 12 o'clock Chicago time, because this was actually Chicago wheat that he was talking about. On September 30th, the last day that the contract would be alive, the option was selling below $1.08, and it looked as though his prediction would not be fulfilled. Mr. Gann said if it does not touch $1.20 by the close of the market, it will prove that there is something wrong with my whole method of calculation. Famous quote there, right? I do not care what price is now, it must go there. And then it says, it is common history that September wheat surprised the whole country by selling at $1.20 and no higher in the very last hour of the trading, closing at that figure. So this actually gives us a bit to look at really quickly. First off, we realize that there's no origin point for this forecast. It doesn't tell us when he made the forecast. All we know is it says during last summer, and obviously summer ends, September 21st or so. So this forecast was maybe 10 days, anywhere from 10 days to 100 days old is what it was basically saying. There was no specific time given. And all Gann's forecast is that this contract, the September contract, would sell at $1.20. There was no specific date given. He didn't say it's going to sell at $1.20 on the last day that it trades. He just said it's going to sell at $1.20. And then on the very last day when it looked like it wasn't going to, it shot up to $1.20, which fulfilled his forecast. But he's also quoted as saying that if it doesn't touch $1.20, there's something wrong with his whole method of calculation. And then he famously says, I don't care what the price is now, it must go there. So this is important for us to look at here because when we scroll down here, toward the end of the article, it says, we have requested Mr. Gann to figure out for the readers of the ticker a few of the most striking indications which appear in his calculations. And then it says, a disclaimer comes up, in presenting these, we wish it understood that no man in or out of Wall Street is infallible. That's where I got the title from the other video right there. So then Gann presents three forecasts, the general market, May wheat, and then cotton. And then the very next, it says whether these figures prove correct or not will in no sense detract from the record which he has. So in other words, Gann makes three actual forecasts in this particular article, just three real forecasts at this point in time. And before he makes it, and after, before it's presented and after it's presented, disclaimers are given that even if they turn out bad, he's still awesome. But then the thing is, the wheat forecast, he calculates that May wheat, that's the 1910 May wheat contract, which is now selling at $1.02, should not sell below 99 cents, and it should sell at $1.45 next spring. So this forecast of his is pretty much exactly like this forecast. There's no specific origin date for the forecast. There's no specific point in time that he's expecting the May wheat to hit $1.45, just sometime in the spring before the contract expires. Now here's the thing. May wheat, Chicago May wheat, never touched $1.45. And it did go below 99 cents. So this contract right here, or I'm sorry, not this contract, but this forecast about this contract right here was a failure. So here's my question to you. Would he be using the same methods to make this forecast as he used to make this forecast? And if that wheat forecast, the actual real forecast that was given in this article, in other words, one of only three things that he gave ahead of time. So in other words, when this article was printed, this was a genuine forecast at that point in time. It wasn't just a bunch of talk about what he had supposedly done. So if this forecast right here that he made doesn't work, he says there's something wrong with his whole method of calculation. But should that be considered true for this particular forecast also? I mean, it's a wheat forecast. It sounds like the same kind of forecast. No specific origin date and no specific date given, just he expects it to sell at that price by the expiration of the contract. So Should we take away from this that there is something wrong with his whole method of calculation? That's my question to you. Why should we accept this as a failure and still be impressed by this and what's quoted as what he's being quoted as saying here? So anyway, I'm going to go ahead and end the video here, and I will talk to you guys in the next one.